This is my YouTube public portfolio series where I invest usually in a different company every single week. I typically invest $100. The short-term goal right now is to hit $10,000 in the YouTube portfolio while beating the S&P 500. Here is a quick look at the portfolio. Our progress is really good so far. Year to date, we are up 21%. As we compare to the benchmarks here, we're beating the S&P 500. S&P is up 12. Total World is up 16, and iShares Core Growth is up 11. So the portfolio is performing very good so far. If I want to take a quick look at some of the shares. So we're at $4,800 in the fund. So we're almost to $5,000. We're pretty much halfway to our $10,000 goal. So that is exciting. If I sort these by most gains to least gains, we can see that most of our companies are in the green, thankfully, and we have a few down here at the bottom that are in the red. So this week, I actually got a little bit more going on this week. I'm going to be investing in 3 companies, and I'm actually going to be doubling down. I'm going to hide those companies so you can't keep looking. I'm actually going to be doubling down on 3 of them, and I am focusing on cannibalistic companies. I found a really interesting article on cannibal stocks, which, you know, the name made me look twice. I was like, cannibal stocks. Essentially, this just refers to companies that are buying back their own shares. They are eating themselves. And the result that it has on earnings is astounding. So after buying back 50% of your shares, if all things remain equal, the company doesn't grow their revenue, they don't grow their earnings. If they buy back 50% of their shares, then their earnings per share goes up by double, which makes sense, right? Half of the shares are gone, so every remaining share carries twice as much earnings if all things are equal. And as the percentage of shares bought back goes up, then this multiple goes up by quite a bit. So a company that's bought back 80% of its shares will multiply whatever its earnings growth would have been by 5 times. And this has a huge impact. So just to showcase this point, this is not one of the companies that we're going to be doubling down on, but this is a company that I've invested in already in the portfolio, is HCA Healthcare Incorporated. So this company, and the reason I'm not doubling down on this company, I've already bought in with this company, but they are a little bit expensive right now. So I'm going to be focusing on companies that are undervalued in terms of the discounted future free cash flow model. So stick around if you want to see how we get into using that model to calculate the intrinsic value of companies to the best of our ability. So looking at HCA, we can see that they have been growing their revenue consistently, but let's focus on pre-tax earning. No, let's use net income to common. So if I go back 10 years, they've got about $2 billion in net income. Now they're up to about $6 billion. So they've nearly tripled their income. Not quite tripled. Let's say they increased it by 2.5. But if I look at their shares outstanding, so if we go back 10 years, they had 427 million shares back in 2015. And now in 2025, they are down to 252 shares. So they have bought back, just in the last 10 years, 40% of their outstanding shares. Now, they have had their income go up along the way by about 2.5 times. But if we look at their earnings per share, it's insane. So their current earnings per share is 24. If I go back 10 years, their earnings per share was just 5. So their earnings per share has gone up almost 5 times, while their actual earnings has only gone up about 3 times. So we're seeing that compounding effect in HCA right now. Now this is a great company, but again, they're just a little bit too expensive for me at this time. So I'm just going to keep holding HCA. Love the company though. Great balance sheet, great income statement. Love the share buybacks and the consistent revenue growth. But now let's move on to the first company that I'm going to be doubling down on, and that is none other than Phototronics. So this company has not been a legacy share buyback company like HCA, but they have started recently buying back a lot of shares. And in their latest earnings report, their latest quarterly earnings report, they have been committing more to more share buybacks. So just to go back quickly, 10 years ago, they were at 78 million shares. They have consistently bought back. Now they're sitting at 61 million shares. However, if we go to their cash flow statement, we can see more recently they have been upping their buybacks. Let's go to the quarterly, not annual view. Oops. Okay. Repurchase of common stock. So like they had a gap for the last couple of years where they hadn't been buying back much shares. We have to go back a couple of years to see another period where they were buying back shares, and it ranged anywhere from 3 million to 17 million. But lately they've upped it to $72 million in that one quarter. And oops, I accidentally went back. Sorry, forgive me. So yeah, in the last quarter, not the last quarter, but let's see. Yeah, in Q2 of 2025, they bought back 72 million shares. And if I go to their most recent quarterly report, let's see, on their capital allocation, organic growth investments, they're targeting a CapEx of 200 million. They are leveraging their business development initiatives, and they are returning cash to shareholders. So far in 2025, they repurchased 97 million. They have increased their authorization by another 25 million, and they're currently authorized to buy back another 28 million shares. And if I scroll down just a bit more, they are forecasting for the next quarter, they're going to go down to 58 million shares in the next quarter. Now, just to remind us, let's go back to their income statement here. So currently, I think they're at 61. Yeah, so currently they're at 61 million shares. So in one quarter, they're going to go down 3 million shares. That's about a 5%, buying back 5% of their shares in one quarter, according to their projection. So, I think that's for the end of fiscal year 2025. They'll be at 58 million shares. So in 1 year, 5%. That is a really strong share of buybacks. We got to go back here to 2019, 2020, and 2021, where we saw those kind of numbers. But this company is getting back into the share buybacks. They are looking really strong in every other metric as well. So in terms of, this company, they are adjacent to the semiconductor industry. They sell masks. So the way that works is it's a critical component to fabbing the silicon wafers. So it's a crucial component of the chip manufacturing process. One of their advantages here is, let's see, where do we see that? Let's go to their previous year. Okay. So first of all, the industry, the chip equipment industry. So according to this article, okay, China, South Korea, and Taiwan to spend the most on chip equipment in 2025 and 2027. So the photomask industry is cyclical. It depends on capital expenditures in the chip equipment industry. China, South Korea, and Taiwan over the next 3 years are projected to spend the most. And if we look at this company, they've got in Taiwan, 33% of their revenue comes from Taiwan, 27% comes from China, and 18% comes from Korea. So they are already well established in the highest growing regions for this company. So they're positioned in a really great place. If we look at their revenue path, so over 2003 to 2017, they had been entering the high-end market. Now they are solidly in the high-end market. They have the first mover advantage in China. They have long-term purchase agreements, extended technology leadership, increased market share, strategic capital allocation. They've been growing their revenue a lot lately. However, whenever I use my discounted future cash flow model, I lean quite heavily on the forecast tab of stockanalysis.com. And unfortunately, there are only 2 years of forecasts, so 2025 and 2026. So the forecast section doesn't give me a lot of information here. Typically, I like to project 5 years out using estimates. So in this case, all I can do is plug in the estimates that are there and then fill in the blanks myself. So let's go to my discounted future cash flow statement. All right, let's see here. So we got HCA in there. Let's go PLAB. Okay, so with PLAB, I've already got my estimates in there. So I plugged in those first 2 years. And then going forward on my high-end estimates, I plugged in 7% revenue growth. On the average side, I plugged in 5% revenue growth. And I I meant to point this out earlier. So the global semiconductor market growth projection for, let's see, where is this projection here? So the outlook for 2026 changed slightly upwards with a projected growth of 9.9%. So this industry is growing by nearly double digit. It's nearly double digit growth, high single digit growth. However, for the purposes of my projections here, I'm going to go with an average of 5% revenue growth on the top end, and then losing revenue every year, 3% for the next 5 years on the low end. And I'm going to be focusing mainly on these low end projections, just so like if the company is still undervalued, projecting revenue loss, then I can be confident that I'm going to see a return on my investment. So keeping in mind the analysts' low projections, I'm using their historical free cash flow margin, which over the last 5 years, the percentage of their revenue that they have been able to create free cash flow has been 14.5%. After adjusting for, I like to make some adjustments for capital expenditures, R&D, and then I count stock-based compensation against the free cash flow. So after those adjustments, their average bumps up to about 15%. So I'm going to give them a 1% boost to the 14%, which now my analyst low projection gives me an upside of 71%. Now I use a discount rate of 8.21%. So what this means is, given that I want a return of 8.2% per year every year, then I would be fine buying PLAB at $38 per share. However, PLAB is currently much lower than $38 per share. They are $21.77. So that represents an additional upside for me because they are so far below their intrinsic value, assuming that they lose revenue over the next 5 years. This is the low analyst projections. So that's a 71% upside given that they're going to lose revenue over the next 5 years. I'm projecting that they will turn their revenue around and make 5% revenue in years 6 through 10, and then a perpetual growth rate of 3%. So that gives me an assumed 71% upside on top of my 8.2% return per year. So if I want to make this a little bit more conservative, then I'll put in my own projections. So for the next 5 years, I want to assume 3% revenue loss every year. For the perpetual growth rate, I want to shrink it to 2. And for years 6 through 10, I want to shrink it to 2. And even with this incredibly conservative growth rate for this company, I'm still seeing on my projection now, $31 projected share price, 43% upside on this future, losing 3% per year over the next 5 years, when they're already in a position to capitalize on China, Taiwan, Korea. They're already in those areas. That's where the most capital expenditure is going to be spent. The industry as a whole is growing by nearly 10% coming in the next year. So if they, despite all of that tailwind in their favor, if they still lose 3% and then only manage to grow by 2% going forward, then their fair share price is 31. So they're undervalued currently. They are upping their share buybacks. So that signals to me that the company is confident that they also believe that they're undervalued. So not only are they upping their share buybacks, they are also upping their capital expenditures. So let's go back to their financials really quick and just look at the capital expenditures. So on the cash flow sheet here, I can see capital expenditures. So they're projecting $200 million in the fiscal year 2025. They spent $131 million last year. So they're flying in terms of capital expenditures. They're increasing that by quite a bit. This company is confident. They're putting money back into shareholders. They're buying back shares while they have a really good chance to increase their revenue going forward, their profitability. It looks like they're undervalued to me. And when you couple that with share buybacks, it is a great combination. Every share that they buy back cheap now is going to pay us shareholders dividends down the road in terms of increased earnings per share. So PLAB, this is the first company that I am doubling down on this week, doing 3 companies. The second company, which this is a legacy share buyback company. This next company has been buying back shares in spades for a long time. I'm talking about PayPal. So let's look at the income statement really quick. If I go back 10 years for PayPal, they had 1,229 shares outstanding diluted. They are now down to 1,000 shares outstanding diluted. So that's nearly 20% share buybacks. But if I look more recently, I see in the trailing 12 months, they've bought back 6.7% of their total shares. In fiscal year 2024, 6%. In 2023, 4%. And then in 2022, 2.36%. So they have been ramping up their share buybacks quite a bit. Now, let's go to their latest earnings report really quick here. See if I can find where they talk about their share buybacks really quick. Or actually, not their share buybacks, but their projections, their forward guidance. So they are projecting. So first of all, in April of 2025, they projected 4 to 5% transaction margin growth. In July of 2025, their most recent report, they upped that guidance to 5 to 6%. So they're upping their guidance going forward. They are planning to repurchase $6 billion worth of shares in fiscal year 2025. So that's what I want to compare to the previous year really quick. So, and to see how much money they spent on share buybacks, we go to the cash flow statement. So let's scroll down here to the financing section. Repurchase of common stock. So yeah, so in 2024, they bought back just over $6 billion. They're planning to buy back at least another $6 billion in 2025. So if it was 6.5% of their shares bought back, this year it'll be closer to 6 instead of 6.5. But yeah, tons of share buybacks. This company is, not only are they buying back their shares though, they are also growing their revenue and growing their earnings very nicely. Let me go to the financials, income statement. Okay, let's look at their revenue growth. So as I go back in time, I don't see a single year where they've lost revenue. Oh shoot, I keep hitting back. I don't see a single year where they've gone down in revenue, every single year. So 10 years ago, they were at under 9 billion. Now they're over 32 billion. So they've increased their revenue by 3x. Let's go to their net income. So if I go back 10 years, they were at 1.2 billion. Now they're at 4.7. So they've nearly 4x'd their net income. However, when I go to earnings per share, and I scroll back, only $1 now, or sorry, 1 in earnings per share, now up to 4.7. So they've increased their earnings per share by 4.7 times. So in this process is only going to accelerate as they buy back more and more shares and continue to increase their revenue. And when I look at their investor presentation, it looks even better in terms of their future growth. So this white section right here, this is their transaction margin growth. And then the blue section is their earnings per share growth. So for 2025, they're projecting their earnings per share is going to grow 6 to 10%. By 2027, they're saying their profitability is going to be increasing even more. Earnings per share is going to be growing in the low teens. And then long term, their ambition is to grow their earnings per share by more than 20% and grow their transaction margin by more than 10%. So their goal here and their projection is to increase their profitability and their revenue every single year on top of buying back shares. Let's see what this company looks like in terms of intrinsic value. So let's throw in PayPal now into my automated spreadsheet. And then I already copied down their projections right here. So I'm going to go ahead and paste in their projections. These are the analyst projections, high, average, and low. Let's paste that in. So given the projections, I also need to adjust their free cash flow margin. Let's return these assumptions to baseline. So we'll say 3%, or we'll say 5%, 3% perpetual, 5% in years 6 through 10. And their adjusted free cash flow margin, taking into account giving them 10% back for R&D, giving them 10% back for capital expenditures. I count cash acquisitions against by 10%, and then I count 90% against stock-based compensation. So given those assumptions, we're up to 16%. So I actually have to take a little bit off here. Let's subtract 3 to adjust their free cash flow margin down. But even with that assumption, according to the lowest analyst revenue projections and their adjusted free cash flow margin, the low end on intrinsic value is 91, representing a 39% upside, including this 8.21% rate. And sorry, Hokage, I'm just now seeing your I'm just now seeing your messages here, your chat. What is minority interest and how it affects the intrinsic value stock in this model? Okay. So minority interest, this is ownership that is not shares and not insiders, pretty much. So minority interest counts against. So if let's say this company has a significant amount of minority interest. Let's just add a number in here just to show like what happens. So let's say, and this would be in millions. So what's the best way for me to do this? I guess I can just put in a big number and then undo. Let's put in $10 billion of minority interest. And you can see that now the lowest analyst projection just gives me a 24% upside. And then if I back out, as opposed to a 39% upside. So this is other ownership coming in. They are owed a percentage of the earnings, or in this case, they are owed a percentage of the free cash flow. So whatever free cash flow I'm calculating, this other ownership interest takes some of that earnings for themselves. So whether that's in the form of, like, at the end of the day, if the company liquidates, they would get a portion of the sale price. If they start paying a dividend, they'd be getting a portion of the dividends, etc. So this counts against a company. You do not want to see a high amount of minority interest. And in Warren Buffett's book on red flags in the balance sheet, income statement, and cash flow statement, he lists a high minority interest as a red flag. I can't remember what his reasoning is. I want to say it has to do with a lot of times if a company needs funding, then they'll seek investors, they'll pick up minority interest in that way. If they're not able to fund their own growth, it might have been something along those lines, but essentially this counts against the company. You also said PayPal is strange. It hit 79 and dropping back all the gains. Yeah, it is really strange. In terms of forward guidance, in terms of the analysts, in my mind, everything looks good about PayPal, and they are buying back shares like crazy. Let's go to the overview really quick. So in the last 5 years, PayPal was at all-time highs. So in 2021, they were $300 per share. And what's crazy is if I go back to 2021, $21 billion in revenue, and they've increased their revenue by 50% since then. They've increased their earnings. They've bought back shares. Everything looks good. Now, why would this happen? It probably, I haven't gone back and researched what the expectations were at that time, but obviously investors had really high expectations for revenue growth and earnings growth at that time, and we can see the revenue was growing by 18, 15, 20, 18, and then the revenue growth slowed down, 8%, 6%, 4%. So investors were anticipating maybe revenue accelerating even more. Maybe they were anticipating we'd be increasing revenue by 30% by 2024. And when that scenario didn't happen, the share price dropped, the multiple shrank, etc. I felt bad I didn't buy more when it hit 79. Well, good news, man. It's at 66 now. So I think it's a really good time to buy. It's a good time to double down. That's why PayPal is the second company that I am doubling down on. And I think I went through all these links here. Yeah. Okay. So they're projecting lots of growth going forward. The analysts like it. Let's go back to the forecast section. The analysts, in terms of share price projections, we have a little bit of a mixed bag. But in terms of revenue growth, the revenue growth looks pretty solid. The upper end is double digits. The lower end is, just a little bit of revenue loss. So let's look at a worst case scenario really quick and see, what can we expect if the worst happens. So let's say instead of 5% revenue growth, and this goes into my projection right here. So instead of 5% revenue growth for the next 10 years and then 3%, which would give us an 83% upside, let's say they lose 3% of their revenue over the next 5 years. They have a perpetual growth rate of just 2 and 2. So from what I'm seeing, this is what the market thinks is going to happen with PayPal. Something like this. They're going to be dropping revenue over the next 5 years, and then they're going to have, a lackluster, just growing, just not even keeping up with inflation really, but with that assumption, like if you think PayPal beats this assumption, then today is a great time to buy. And I do. I think PayPal beats this assumption right here. One thing I always like to look at, I referenced the Warren Buffett red flags. Hokage says a lot of companies like ASML, Crocs, Lulu dropped because of revised future guidance, some due to other SpaceX speculation like Iridium. Yep. No reason ones are Simply Good Foods and PayPal. Yeah, it is hard to say why PayPal is dropping so much, other than I keep thinking that people are just, or the market had priced in way more growth than what was reasonable for PayPal. And so now here we are. Right now the market, in my mind, it's snapped back too far in the wrong direction. So let's see, going back to the dashboard, this is what the market thinks: losing revenue over the next 5 years, which again, they've not lost revenue in the last 10 years. So they've been looking so good for so long. They're on a really great streak of increasing their profitability. So I just think that PayPal is very likely to beat this scenario right here. So we're doubling down. Andros, how are you feeling about NVIDIA? So I'm actually going to be a little bit of a preview. I'm going to be doing a video here pretty soon on the Magnificent Seven and which Magnificent Seven company I like the most. I think, I haven't done a deep dive in NVIDIA in the last month, but last time I looked, NVIDIA felt a little bit too expensive to me. They've had stellar growth. They've looked great. Their balance sheet looks great. Everything about them looks awesome. My problem is that at least a month ago when I looked, investors are pricing them for perfection. Like they're just going to keep going on this tear. And I think there's a lot of possibility that competition could start to come up on them. They have huge concentration risk in terms of their customers. They have just a few customers that make up a massive percentage of their data center revenue. And a lot of these customers are also working on developing their own chips. So there's just lots of things that could go wrong with NVIDIA. I find that to be risky. And so we'll see. But, like I said, I still have to do a deep dive on this company again. So maybe they will surprise me. Okay. Oh, and Hokage, you brought up ASML and Crocs. Both of those companies are also buying back shares pretty well, especially Crocs. I am loving Crocs. Tommy Shelby, what's up, man? AU, how you doing, man? Glad to see you. Okay, so we're moving on now to the third company. The third company that I'm doubling down on, buying back shares, a cannibal company because they're just eating themselves. We're looking at Adobe. So let's look at first their revenue. If I go back 10 years, they've had consistent double-digit revenue. They're still in the double-digit range, but their revenue has slowed down, their revenue growth. A lot of investors have fears about AI taking over Adobe's business model. So we're going to look at that a little bit, but let's scroll down to the shares outstanding. So 10 years ago, they had 507 million shares outstanding. Now they're down to 440. So they've dropped over 10% of their total shares. And once again, this company is also ramping up lately. So if I scroll back, I see, 0.5%, 1%, 1%, 1%. Now they're ramping up to 2.5%, 2, 3.5%. So they're upping their share buybacks. And we're going to also look at their free cash flow valuation. Hokage says, also Broadcom is trying to challenge NVIDIA's crown. Yes, that's true. However, according to Jensen, even if our competitors take away chips for free, they can't beat us because we have the best cost of operations. Interesting. That may be true. That's something to look into. I will report back on that here in it'll be a few weeks before the video drops, but that's what I'm going to be. That's one of my next projects. Okay. Share buybacks, lots of share buybacks. Love to see it. Let's look at their growth prospects going forward. So I pulled up their latest earnings report. Looks like we got a refresh here. And it's a little bit small. Let me zoom in for y'all. Okay. And myself. Scrolling down here. Okay. The following update summarizes Adobe's fiscal year 2025 targets. So their target revenue is $23.55 billion. Their current revenue, or for fiscal year 2024, was $21.5 billion. That represents another 10% uptick in revenue. So they're on track for another double-digit year in terms of revenue growth. In terms of share buybacks, I know they talk about share buybacks. Adobe purchased approximately 8.6 million shares during the quarter. So that's in one quarter. Let's go to the quarterly view here. Let me scroll down and see how many shares are they buying back. So yeah, going from I'm seeing about 8 million shares going from quarter one to quarter two. So it seems like they're on that streak. They're going to continue that streak, and I love to see it. 2.5, 3.5. Now they're up to actually 5% share buyback year over year for Q2 of 2025. That is just huge. If they keep this up, 5% of their shares being bought back every year, then they're going to be accelerating their earnings per share like crazy, which gives us, that is return right there. That is where the free cash flow comes in. And that is why I love to use a discounted future free cash flow method for calculating intrinsic value, because it is the free cash flow where companies get the money for share buybacks. That is the pool of money that's used. Free cash flow is used for expanding their operations. They may put that money into buying other companies, cash acquisitions. They might expand their own operations organically. They might use it to pay dividends, buy back debt, or buy back shares. So it's the free cash flow that we want to see. And I also want to see not only that they're buying back shares, but I want to see that they are cheap compared to their calculated intrinsic value, because that just means I'm getting more bang for my buck with that free cash flow. They're using their free cash flow to buy back shares at a good time. That's even more, I don't know if it's even more important, but it's also very important. So now let's calculate the intrinsic value of Adobe. Let's see, ABE, boom. Let's see, got to reset all this. They have a amazing free cash flow margin. Let's reset this. Okay, the analyst projections are right here. This is pulled off of stockanalysis.com. I just pasted it here ahead of time. So with the analyst projections, so according to the lowest analysts, the target share price, the intrinsic value today, assuming 7% growth, 2%, loss of 3%, 1%, 0%. So pretty moderate growth. For 2025, they're projecting 10% revenue growth. So even this cell right here is like, I know it. I had been putting a negative number into the lowest analyst projections in the past, but this is 3% lower than what's projected. And there are, how many quarters in are they? What quarter was this? This is Q2. So they're halfway through the year. It's going to be hard for them to blow their projections at this point. Halfway through the year, there's not much time left for them to screw up so bad that they don't hit their 10%. So, I mean, it could happen, but unlikely. So 7%, 2%, not -3, 1.5, and 0. So with that projection in mind, years 6 through 10, we got 5% projected growth, and then a perpetual growth rate of 3%. The lowest analyst projection gives me an 11% upside on top of my 8.21% return every year. Okay, Hokage, what about Adobe being challenged because of advanced AI tools? Are they also adapting AI integration into their products? Great question. I believe there was something in here on that exact topic. Let me see if I can find that. Great question. Maybe it's not in here. It may have been in their investor presentation. The short answer is yes. their AI tools are growing quickly. That's the short answer. As far as acquiring the proof for you, we're going to need to go back to Adobe's investor relations page. Events and presentations. I feel like it was in here. Q&A session. AI Works webcast. Not sure where I saw that. Andros, NVIDIA just has such a hold on the space. Best hardware, best software tooling, and now they are starting to experiment with that in specific industries. Yeah, that's a good point. That is a good point. There's a lot to like. There is a lot to like with NVIDIA. They are a great company, but the price, they're still, no matter how great a company is, it can always be too expensive, To say that, and I'm not saying it yet, but even to say that I don't like NVIDIA as an investment, they could be a stellar company. If they're just too expensive, they're too expensive, There could be nothing not to like. Like, it could be all good, but if the price is wrong, the price is wrong. And that's what I always fall back on is, at the end of the day, given conservative growth assumptions, what does their discounted future free cash flow look like? How much are they going to be able to return to shareholders? And if it makes sense, then I invest. That's how I do it. Okay, where were we? Man, I know I saw something in here where they talked about, and I may not be able to find it. Events and presentations. I feel like it was in here. Let's look at this. Nope, we're not looking at that. Earnings call. No. Oh, we got a September 11th. So tomorrow they have an earnings call. So, it's probably wise for me to, it absolutely is wise. I'm not going to put $100 yet. I'm going to wait tomorrow. I'm going to see the latest projections. I'm going to see the results. And then, assuming the spreadsheet still looks strong, then I'm going to be doubling down on Adobe. I'm going to wait, and I always recommend waiting for the latest quarterly report, the next quarterly report before investing, especially if it's just right around the corner, because you want to invest with as much current information as you can, because a lot of times big things can change on an earnings report. It could be in your favor. It could be that you buy before the report and then a bunch of good news comes out and you get a lot of gains. That's always nice. But sometimes we see bad news and then you wish you would have waited. So I don't want to leave it up to chance. I want to wait and get the information and then make an informed decision. So that's the play there for me. Let's see here. Investor presentation. I feel like it was in here. Let's look at the investor presentation. And they have something by segment. Okay, here we go. Creative Cloud. Let's see. Might have to do a little bit of a search. We want a great company at a fair value. Yes. Good point. Wait for earnings. Lulu, I took the risk and it did not pan out. That's right. I got burned, man. It's always best to wait and have the best information. And by the way, Lulu looks really good now. Like I feel like the reaction on Lulu was way overblown. If you run the numbers on Lulu, they are very undervalued. They cut their future earnings a little bit, but not by that much. Not by that much. Let's see. I think we're gonna have to go a different route here. It's taking too long. Let's do a word search for AI. I know I saw it. New AI first products. We got it. Okay. So their existing portfolio, year-over-year growth, 4x. Let's zoom in a bit so we can read a little bit better here. Oh, this is Adobe's AI monetization. So it does appear that they are utilizing AI. Quarter over quarter increase in Acrobat AI Assistant, about 2x, quarter over quarter. So their Acrobat AI Assistant is being used. So as far as I can tell, they are utilizing AI. They're embracing it. They're not fighting against it. 2.5 times, 2.5x year over year growth in generative credits consumed. So people are using Adobe AI tools. So looks good to me. Both Lulu, Iridium, way overblown. I agree, and I need to look at Iridium again. I think that would be a good idea. So all right. I think Adobe looks solid. And when I go to the free cash flow, the lowest analysts I'm seeing an 11% upside, and that's in the worst case scenario. It's always important to consider the upside as well. If the highest analysts are correct, we're looking at about 100% upside. If we see the average case, we're looking at a 55% upside. So Okage, good to know they are embarrassed. I meant embraced. Okay, yeah. Good to know they embraced. We don't want another BlackBerry, Nokia. Yeah, 100% agree. Innodata, sorry. Paul K. Let's see. INOD. I have not looked at that company. Let's give them a quick look. Adobe. I'll wrap up Adobe really quick. I think they look great. The one last thing I was going to do. I'm curious. What does the market think that Adobe's going to do? You know, what's the market thinking? So if we assume 3% revenue growth over the next 5 years, 3% revenue growth for years 6 through 10, and then a 2% perpetual growth rate, so lackluster growth, then they are roughly fair valued right now. So that is the question. How likely is it that Adobe beats this projection, considering they are looking at double-digit revenue growth this coming year and last year? I think it's more reasonable to assume 7% over the next 5 years on average, because they may slow down. Their trend has been slowing down their revenue growth a bit. So if I assume 7%, and then we assume a little bit more slowdown, 5%, and then we assume a weak perpetual growth rate, then we're looking at 25% upside. So for me, Adobe's, I'm doubling down on Adobe. I'm putting another $100 this week into Adobe, but I'm going to wait. I'm not going to do it today. I'm going to wait till the new information comes out tomorrow. So, okay. So Paul wanted to see INOD. Let's look them up. Let's do another company really quick. Innodata overview. So what have they done in the last 5 years? Okay. So they have, they've popped off a little bit recently, 300% this year. So they've popped off quite a bit. Innodata operates as a data engineering company in the US, UK, Netherlands, Canada, internationally. Digital data solutions, Synodex, and agility. Okay. Interesting. What does the forecast say? In terms of share price projections, it is leaning towards the downside. In terms of analyst recommendations, I see strong buy and buy, so that looks good. In terms of revenue projections, they only are giving us 3 years of revenue projections, and oh my gosh, huge revenue projections in 2025, but only 3 years. So let's take a look. Let's paste these projections into our automated spreadsheet. What do we got? Also, I have to do a little bit of extrapolation. You know, I don't know about these 2 years. But I'm also gonna overwrite 2027. I'm gonna throw 20% revenue growth in there. And for the average, we'll say 10. And for the low, we'll say 5. We'll go 5. Okay. Given those projections, and a free cash flow margin of 34%. Solid free cash flow margin. I do have to bump it down. Oh, shoot. I still have Adobe in there? I could have sworn I switched it. My bad. INOD. Okay. free cash flow margin of 3%. So not the best free cash flow margin. And actually, I have to adjust it even more down because of the stock-based compensation. So let's actually look at that really quick. I want to talk about why I penalize companies for stock-based compensation. So over the trailing 12 months, and it's really not that big, actually. It's not a huge stock-based compensation, but they paid out $7.5 million. So maybe this isn't the best example because it's really not a huge amount. But their free cash flow was 36. So I count a lot of that 7 million against it, especially if they're buying back shares, which they're not. So, maybe it's not the free cash flow, or it's not the share buybacks that I penalize them for. It looks like it's just this negative and these zero amounts that are pulling the average down. So they've been trending up in terms of profitability. So I'm going to give them credit for increased profitability. We're gonna up their numbers here. I'm gonna use their most recent number of 14. We're just gonna go with that. We'll say that they're able to maintain their current profitability. So we're giving them credit for 3 plus 11. That is 14% free cash flow margin. We're giving them credit for, on the upper end, 20% revenue growth in these years, 53 and 30. Given those assumptions, it appears that they are overvalued. There is a downside. The intrinsic value, given the assumptions that I've made. I'm not saying these are accurate assumptions yet. I don't know this company very well, but given the analyst projections for revenue growth and their current profitability, and maybe they are able to increase their profitability, they are considered overvalued in terms of discounted free cash flow. But let's look a little bit more. Let's say they're able to maintain 30%. I'm just curious. Let's put some higher projections in there and see if it changes much. So given 30% revenue growth over the next 5 years, they're still overvalued by about 17%. What would it take? I would need to see even more revenue growth, or I would need to see more revenue growth or free cash flow margin growth. So I built in 1% free cash flow margin growth per year for the next 5 years. Now we're starting to get into a little bit of an upside with the highest analyst projections. So for me at this time, I'm going to say this company looks a little bit too risky for me. The stock market is clearly anticipating a lot of growth with this company. I think, at least right now, it looks like it's been pushed up a bit too high. But hey, this is not a deep dive. This is just a quick surface level look. And one other thing that we can do to add to this is look at the Buffett supplement. I think I mentioned it earlier, but I did not actually get into it. So Buffett gives his red flags in one of his books for the income statement, cash flow statement, balance sheet. He looks for certain ratios to see if they're above a certain level, then a company will have a strong chance of having a durable competitive advantage. And then if they are below a certain level, then it is a red flag. Now, if a company has a red flag, it doesn't necessarily mean that it is a bad thing. It just means I need to look into this a little bit more. So typically, if a company has lots of red flags, then I don't invest, because it takes a lot of time to dig into all the red flags. I'd rather just invest in companies that have a bunch of green flags. Paul says, fair, so they might be poised for a correction before further growth. Maybe, or maybe they have, maybe in their next earnings report, they have some really, really good news and all of their share price gains were justified. That could also be true. I guess I want to make sure people, like when I say a company is overvalued, it's just to say that I'm not confident enough in their future growth to justify their current share price. It could happen. But I like to see an upside given conservative growth. And if I see an upside with conservative growth, then I'm more likely to invest. Okay, but let's get into this red flag, green flag analysis. So in 2023 and before, there were lots of red flags. In 2024, I'm not seeing any red flags. So they don't spend any money on R&D. So that's nice that they don't have to do that. Gross margin is pretty high. Their interest expense as a percentage of operating income is very low, meaning they don't have very much debt. They have a solid profit margin. Their profits have been going up. Earnings per share has been going up. Zero long-term debt. Love to see it. Not going to get into the receivables. Not going to get into this. Their retained earnings has been going up lately. It looks like they had some losses in the past, but in fiscal year 2024 they've started to be profitable, and so I think that's where we're seeing their share price going up quite a bit, because now there's some expectations for some earnings. Their debt has been going down. Their cash reserves have been going up, so all that looks good. Goodwill has been relatively steady, and then CapEx is low enough. Depreciation is low. They have plenty of liquidity. So in terms of their health, they look solid. Now, I will say this. I will point out that they have been diluting a little bit. So between 2023 and 2024, their total number of shares went up by 14%. So that is tough to see. But this is a company that's growing. Clearly, they need to raise cash. They need money to grow. So this may turn around. They might start buying back shares here in a couple of years after their profitability goes up and they can fund their own growth. But at least for now, they're having to issue shares of stock. But at least they don't have debt. They're just issuing shares. So, I mean, they look like a strong company. Clearly, the market loves them. We'll see. I'll have to keep my eye on this company. It looks like a strong company. Thanks for the tip, Paul K. I appreciate it. Always like to look into companies that my viewers suggest, because a lot of the companies that I've invested in, I found because a viewer suggested it. So, I love to look into it. But anyway, that's all I have for y'all today. If you have other companies that you want me to look into, catch me next week. I stream every Wednesday around this time, 7:30, 7:15. I typically start. So, yeah, hit me up next time. No problem, Paul. Appreciate you tuning in. I hope I see you next time. And if you have another company you want me to look at, I'm happy to check them out and do a quick little dive. And then if you bring up a company that looks really good, then I probably will make a video about it, or do like a whole live stream featuring the company. If they look really strong, then I'll do a deep dive and be prepared, the following, or the next stream. So yeah, see you next week, man. All right, y'all. Thanks for tuning in. We'll catch y'all next time. Hokage, good to see you as always. Andros, good to see you. Tommy Shelby, if you're still around, thanks for tuning in. Yeah, we'll see y'all next time. Cheers.